Welcome to Driving Alpha, where we feature our friends, the outperforming investors who demonstrate their path to driving alpha or outsized investment returns. We're Alpha Partners, where we partner with 1,000 early-stage venture firms as their opportunity capital to invest in their best companies.
Thanks so much for joining. Obviously, frankly, I've been watching your pod, and you inspired me. And I have a lot of, as you know, we partner with 850 VCs, and so it's the perfect platform to spotlight our partners that we work with.
Yeah.
And frankly, when we hosted that dinner, you're like, oh yeah, I'll definitely come to that with 12 LPs.
Yeah.
And it's all incremental. But I was just thinking, geez, why don't if I could just use the power to promote my partners to all the LPs that I talk to on a pretty frequent basis,
right,
and spotlight it, and especially you. Like, I feel like you have a outsized personality. As we're friends.
I've been told.
A long time. But I think what gets lost in translation is that you're an investor.
People forget that I invest in 100 companies per year, and I've got a 21-person team, excuse me. And we did, I think we did 60 or 70 introductory meetings last week. And so we are one of the highest volume, most prolific seed investors in the United States today. You have Y Combinator doing, I think, 250 startups per class twice a year. That's 500. And then Techstars, I'm not sure where they're at right now. I know they had some leadership changes, and they operate in many different cities. You have 500 global, previously 500 startups. And so there's not many people who, do 100 a year, let's say. It's probably 5 or 6 of us. And, it just takes a different process. So people don't understand what pre-seed and seed stage investing at scale requires, because there's only like maybe 5 people who've ever done it. Ron Conway, Y Combinator, Paul Graham, Jessica, and the team over there, Dave McClure, and Courtney, and the team over at 500 startups, now global, and then the 2 Davids at Techstars. I'm not sure if anybody else has ever done that kind of. Oh, Ron Conway. Yeah, I think Ron Conway also hit those numbers. So it's just a different portfolio construction. It's a different day-to-day life. It's much different than venture capital. I feel in a way we're not a venture capital firm, even though we have venture capital funds that we do, and we have the same compensation, but we're really a startup factory and an index in a way.
Yeah. Well, I feel like
we've started, right? We're recording.
We started recording.
We're in a podcast right now. There we go. I guess that was the first question.
Absolutely. Yeah. So let me just say a few words about the pod. And I just wanted to thank you. Hello, Jason. Thank you for joining us on Driving Alpha. Driving Alpha was inspired by a day of driving 12 super exotic cars that I hosted with a few years back with about a dozen VCs. And what happened was we swapped the cars every hour, and each VC got to meet another VC and ride with them for about an hour. And what we found at the end of the day was it was cool driving in the cars, but the best part of the day was meeting the VC, spending that hour of time learning about each other and each other's edges and what they were looking for and how they added value. And there are a lot of revelations that came out of that. And so this podcast is sort of a virtual exotic car tour in a way, in a quest to find out what drives alpha with some of the best known and even lesser known VCs, and how they view creating outside investment success. And we were just getting into it with you. But every great VC and investor has at least one superpower, sometimes a few. And we wanted to use the pod to kind of shine a light on that superpower in that car ride, so you could share a little bit more about how you view investing. This is our second episode, and obviously, you're well known as the world's greatest moderator for the All In podcast. I've listened from the near beginning of the All In podcast. I'm a loyal weekly listener. You actually inspired me to create this effort, and it's clearly one of your superpowers. Love to hear more about how that impacts your investing. And, you know, if you want to hear a great weekly podcast on tech and world affairs, I recommend any listener to tune into the All In podcast. Jason and I met over 25 years ago when he was the publisher and editor of the Silicon Valley Reporter. Um, you might have had a predecessor vehicle before that, right?
Yeah, I
Or
had
no, was that?
it's really interesting. I had a magazine called Cyber Surfer that I did 5 episodes of right before the internet became commercialized and there was a web browser in the early 90s. CD-ROMs had multimedia and online services, Prodigy, AOL, CompuServe, the Well. These were like the precursors to the internet revolution. And so I had Cyber Surfer, which was kind of cyberpunk coverage of this new technology. And then when Silicon Alley startups started happening, I created the Silicon Alley Reporter as a newsletter, which I kind of cribbed the format of Release 1.0, Esther Dyson's newsletter. And it was a 16-page photocopy. But I kind of loved Spy Magazine, Paper Magazine, Esquire, Rolling Stone, the whole New York cohort, Vanity Fair, and I went with a magazine style, which was very strange at the time for a business publication to be like a flashy magazine. And I threw parties that were quite well known, and it was quite a fun time, I will
So
say.
the circulation was 500 because that's how many entrepreneurs there were in Silicon Valley at the time, or like
It's funny.
how big did he get it up to?
Yeah. So it was, I think at the peak, maybe 30 or 40,000 printed copies.
Wow.
Yeah, so it
Wow.
got pretty big. And the online newsletters were bigger, obviously, email newsletters at that time, and the events were a big part of the business. But to your point, in the first year, we decided to do the Silicon Valley 100 concept. And it was originally, we tried to find 100 people working in the internet industry. And when we made the complete list, there were 40. So we asked
You're
the
right.
40 people, do you know anybody else who has a website? This is 1995, or is building anything on the internet? And they're like, well, these are my attorneys. Like there's internet attorneys, and there were like two of those. And these are my accountants, and there's a headhunter, and there's a PR person. So we literally, just to get the list to 100, added like 20 service providers because I was desperate to get to 100, and then we ranked them. And it was quite fun as an exercise. And lo and behold, you know, the dot-com boom happened, and the magazine grew to about $12 million in revenue. And that was quite an achievement from a cold start. And I did a publishing business after that called Weblogs Inc., which was notable for Autoblog, Joystick, and Engadget, which was Steve Jobs' favorite blog. And it was the #1 blog in the world for a couple of years, actually, in terms of traffic. It was literally #1. And sold that to AOL, made a little bit of money. And then eventually wound up at Sequoia Capital as their first scout. And in the scout portfolio, Ruloff and Doug Leone and Michael Moritz asked me to be the first scout. In that first scout class was also a quiet, awkward young founder named Sam Altman. He had done an app called Loop, but he was super impressive to me even at that time.
Hmm.
And he did this weird payments investment in a company called Stripe in the seed round. And then I did Uber in the seed round. And that fund at Sequoia is, I was told, their highest performing on a percentage basis fund ever, because it was only a $3 or $4 million fund, and I think it returned maybe 200 million or something crazy.
Wow.
So maybe not cash on cash, but on a multiple basis. But being a scout for Sequoia and getting to hang out with Michael Moritz, Doug Leone, Alfred Lin, Jim Getz, just the whole team over there was extraordinary. And of course, Rulof Botha. I got some really good mentorship, being friends with Bill Gurley and other folks in the industry. I got a lot of great lessons on how to spot talent and great ideas and to be a good investor. And I realized it's the same job as being a journalist. You ask questions, you listen deeply to the answers, you try to figure out if the person is full of it, or they're brilliant, or somewhere in between, or both. Who knows? And you try to place a bet. The output of being a journalist is a story. You make a bet on that story being interesting to the readers, and to the test of time, and being interesting in the world, and prescient. And
Interesting.
then in venture, you write a deal memo after asking all those questions, and then you place a bet, and then you hope for the best. And 10 years later, you find out if you're an idiot or not. But I find the work of being an investor, just intellectually, spiritually, emotionally, uh, cognitively, just absolutely suits my style. I love doing it. I love hanging out with young founders, even older founders, just young at heart, want to change the world, want to create something from nothing. I think it's one of the most fascinating careers in the world, being an investor in early stage startups. I don't think being an investor in late stage startups is very particularly interesting, because it's just a calculation. No offense to people who do it. You're not really taking too much risk. You're kind of studying a spreadsheet and then just outbidding everybody else, whether it's less rights and a higher price. And so it's particularly interesting to me. And I have 21 people now. We make 100 investments a year. We are just completing the raise of our fourth fund. And yeah, I feel very privileged to be able to do this work every day.
How did you, so from Sequoia Scout,
yeah,
is that when you launch?
Yeah, so I was a scout, yeah, and
right.
I started a conference called Launch Festival. I had originally been partners with Mike Arrington, a little bit of a sordid tale, and we did something called TechCrunch 50, because he didn't know how to do events, and I had done events, and he said, "Hey, will you please do this event with me?" So we did an event called TechCrunch 40, then TechCrunch 50, where we had 50 companies launch. He had a great brand in TechCrunch, and I had this great idea, and I was a great, MC on stage. He wasn't very natural on stage, and in fact, quite the opposite. He was a little bit curmudgeonly, which was why he was a great writer, but terrible at being on stage or interfacing with the public. And so, but we broke up. It was the best thing that ever happened to me. Started Launch Festival, and had 15,000 people at the largest one. And then
what year was that?
Gosh, I can't even remember. 2010 maybe. And my friend David Sachs, who had won TechCrunch 50 with Yammer, which he sold to Microsoft, said, Jaco, and we were friends, you spotted our company, you picked us as the winner, and you didn't have any stock in it. I feel terrible. I said, oh, okay. Well, can you give me some shares? He said, well, we sold the company already. But how about you start your own venture fund? And I said, that's interesting. Naval from Venture Hacks and Angel has told me I should start a fund. How do you do it? And he's like, well, just ask your friends for money and then just keep doing what you're doing as a Sequoia Scout. So I kind of graduated from Scouts and raised a little bit of money, 10 million around the poker table from my friends. Rest in peace, Tony Shea. Rest in peace, Dave Goldberg, two of my poker buddies who passed away. Jeff Skoll, Bill Lee, Chamath, David Sachs, of course, just a bunch of my friends. We passed the hat, and then I deployed that 10 million in 109 startups, I believe, and hit 4 unicorns. Calm, Robinhood, Density, and Superhuman in that first fund. And I learned a lot because
what year was that?
It was 2010, 11, 12, 13, 14. It took like 5 years to deploy that 10 million. I was doing it part-time. It was like this concept of a solo GP, part-time. What they called a super angel at the time was a very new concept. Chris Sacca had just done it with his fund, and we had both co-invested in Uber together, obviously. And I was kind of watching what Chris was doing. And I think he had an $8 million fund, was his first fund. And I think maybe Ron Conway, Chris Sacca had copied Ron Conway maybe to a certain extent, and Ron Conway had done like a $10 or $20 million fund. And so these
Josh Koppelman started out that way too. He was really
I guess so. Yeah, first round,
format, right?
Yeah, and I introduced first round to Uber famously. I had introduced 3 people to Uber. I had introduced 21 people to Uber. 3 of us made the investment. Cyan Bannister, myself, in first round. Chris Sacca had done it independently, so I get no credit for that intro. And
never email those people, those old emails saying, ha, 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 ha.
Well, interestingly, I'm good friends with Mark Suster, and Mark Suster and I are on some boards together, and we're good friends, and we've done some podcasts together. And he always brings up that he was in the room when I had started something called Open Angel for him, and I had found out who the 10 or 20 angels were in each city. Sometimes there were only 5, and I just would bring 7 companies together to pitch to, 5 to 20 angel investors. And Uber was one of those companies. And, Travis was always very thankful for me to help him raise that first fund. And to be clear, they would have been successful without me. But, he always defends me and says, Jason was supportive of me in my previous two companies. And, I really, when I needed help with Uber, Jason was always there for me. And again, I take zero credit for, their success, but it was nice to be along for the ride and to be supportive where I could be. And I think, I look back on that first fund, which, is still, very active and has some great names in it. And, as you get to your second, third, and fourth fund, and I have LP'd other funds as my personal wealth has grown, I've tried to dedicate time to being an LP in other funds, and I'm in 24 funds, 4 of my own and 20 other ones. And one of the portfolio construction items I really looked at was spray and pray, which is what Ron Conway, Chris Soccer to a lesser extent, I think, and just anybody who was doing seed investing thought about the space. It was one and done was the concept early on. And then some people started to figure out, you could do SPVs, or you could do, you could buy shares from employees. And Chris did that with Twitter a whole bunch and created a bit of a marketplace there in secondaries. But nobody really thought about follow-on funding. In fact, angel investors never asked for pro rata, nor did they take it. They were frequently asked to waive it or bullied into waiving it. And I look back on that first fund and I asked myself, did we know who the winners were? And it really has impacted my portfolio construction going forward. I think portfolio construction, after you deal with the 3Ds, is really the most critical part of being a venture capitalist.
So. Well, that's actually, I get shit every day because we invest out of our fund, and then people look at our SPVs and they're like, Steve, you're crushing it on the follow-ons on these companies and picking out the winners. And I'm like, yeah, that's, it's almost repetitive. Yeah. How do you pick the winners? So in terms of like, I follow smart guys like you, Jason. That's okay. number one lesson is social proof, but also we have 7 other heuristics we use, like category leadership. It's going to be is it a big category? Is it growing in a top quartile fashion, 100% plus? Is it in a recession resilient type of field? Is it is the business actually working? Are the unit economics of the company actually working, or are they wildly off? And you don't always win, but I really wanted to hear more about what in terms of it sounds, you said spray and pray, but there's got to be some intelligence on the front end, but it sounds like there's also some intelligence and some perspective on how do you pick your follow-on candidates as well.
I have a lot of thoughts on this. This is where I've spent maybe the last couple of years of my career really honing things, because we are, deploying larger amounts of money. We have a bigger team, and I have to train that team. And I was a solo GP. Right. Now I have a partner, Mike Savino, who's a GP and president of the organization. And then we've got managing directors, principals, associates, researchers, analysts, a bunch of people, 21 people in total. And so we had to really think about, how does the seed stage and the pre-seed stage work? Distinctly different than Series A, certainly much different than growth stage B, C, D. And so we looked at what venture capital firms need to do in order to succeed. And I asked a lot of people on my podcast, and there's All In, which has been going for 175 episodes this week. And then there's This Week in Startups, which is at 1,900 episodes. And I've been doing that for 12, 13 years, which, All In was kind of built on the back of that team, my producers, editors, and all the lessons I had when Chamath and I started All In, and then brought Freeberg and Sachs in very quickly to sort of round out the quartet. And what I learned about venture capital firms were there are really the 3Ds that I look for. Deal flow. You are a function of your network and the deals you have access to. So deal flow is critically important. Somebody like Y Combinator or Sequoia, because they're so well known, well branded, have been around for a long time and have a track record, they don't have to fight for deal flow. The deal flow just comes to them. And I am lucky, because of the podcast, to be in that same position. I think we'll have about 20,000 applications for funding this year. And we're not trying to get more applications. I'm trying right now to build up my team size so I can review all the applications, because honestly, the benchmark is so high right now. And I think we maybe only meet with, let's see, if we are averaging about 50 introductory meetings per week, it's about 2,500. And I think we're probably at 20,000. So we're meeting with about 10%, 15% of the companies, maybe a good week, 20% of the companies that apply for funding. So we're very selective in even who we take a first meeting with, let alone invest in. We're investing in 100 companies a year, 20,000 applications. It's 50 bips, it's 1 in 200 get the investment. I think that's probably a really good number. So deal flow is destiny. This is what I tell young venture capitalists and new solo GPs that I invest in. You're a function of your deal flow, and how many meetings you can do will determine your success ultimately. And they think that's crazy, but I know it's true because I watched Y Combinator, Ron Conway, Chris Sacca, myself, Naval. We all just out hustled and just did more meetings and met more founders. So let's just say deal flow is number one. We've got a big checkbox. We're an exclamation point. There's very few. I think we might be in the top 3 or 4 in terms of the number of applications coming in of any investment firm in the startup space.
Yeah.
Okay, number 2, decision making. How thoughtful and precise, considered is your decision-making process? Most VCs, their decision-making process is their gut, their previous success, and a bunch of biases. Oh, these people went to Stanford. Oh, these people are developers. Oh, these people dropped out of Harvard. Whatever it happens to be. And, oh, you made all your money investing in Airbnb. Okay, so now you have a bias towards brilliant designers like Brian and Joe. Oh, you invested in Uber. So you're into people who understand network effects and are hard charging like Travis. Oh, you invested in Larry and Sergey. So you're into thoughtful people with PhD research out of Stanford who really think things through and, are cerebral. You can become a victim of your biases. So you got to really think about decision making. I just had I wouldn't say dressing down, but I blew a gasket the other day because I was like, with my team, where's the weird stuff? Where are all the weird companies that we don't understand? Where are the companies that don't make sense, but we love the founders? And they're like, and I'm like, you guys are bringing me all the safe stuff. Where's the weird stuff that you were afraid to bring to me? Bring me some more odd stuff, because I can tell you, a cab company, a meditation app, and a stock trading app where you don't charge people for the trades, those are our 3 biggest hits to date. $100 billion, $150 billion company, a $20 billion company, and a $2 billion company, Uber, Robinhood, Calm. These were very unpopular companies, very hard to understand. And so, okay, decision making is number 2. Got your deal flow, you got your decision making. How do you come to decisions? And then doubling down and being able to identify.
Before we go to doubling down, what the weird stuff metric? What do you quantify for your team? Mm-hmm. Like, these are the 20 things we look for. We
have 13 things right now, and then we have 25 red flags. Sometimes pink flags. We'll call them pink flags, red flags. The red flags, the pink flags are obvious stuff, like it's an accounting nightmare. We have one like this company is lost in the wilderness, lost on the dance floor. They've been around for a while. They've done 7 pivots. Companies existed for 6, 7, 8 years. So we'll ask, hey, what's the incorporation date? And then when did you launch this product? Oh, we incorporated in 2014. Okay, so the company's been around for 12 years. Or no, 10 years. Okay, and when did you launch this product? Oh, we launched it last month. Okay, well, what did you do for the other 9 years? Oh, we had these 2 other products. Okay, great. Let's have the discussion about that. Cap table concerns. Okay, the founders own under 10% of the equity because they've been lost in the wilderness. They've done 2 pivots. The cap table's broken. There's a huge overhang. Okay, legal issues, accounting nightmare, a very slow vertical to break into, like construction, or it's capital intensive, like healthcare. There's all kinds of categories of things that can be red flags or pink flags. So let's put those aside because, most of them are solvable, to be totally honest. So we just want to highlight that we know there are pink or red flags and how many of them there are. Like, Uber had a lot of lawsuits. So does SpaceX, Tesla, Google, and that's part of being successful is,
so that might be one of the 13 things. Huh?
Well, yeah. So again, this is for early stage. So pre-seed, and seed. Pre-seed means year 0. Seed usually means year 1 or 2. So when you look at those companies, we've identified 13 categories we look for. If something has 3, 4, or 5 of them, we're definitely going to take a second meeting. 4, 5, or 6 of them, they are very likely to be a company we want to be in business with. Builder founders, it's way up high on the list. What's a builder founder? It's a developer who writes code and who has over 10% ownership. So when we say builder founders, we define founder as over 10% ownership, meaningful ownership percentage. Builder founders, for me, is 3 categories. You write code, you design the product, UX design, like literal designing it. Not a product manager. PM, all due respect. A lot of people can be a product manager. I'm talking about design, and I mean really world-class design, like Uber and Airbnb. And
was Travis a coder or a designer?
That there are exceptions to it, and I'll get into that.
Right.
But I would say he's a product designer for sure. Really like an architect of products. And then there's growth hacking, and that's my third. And I would say Travis had product design and growth. He really knew growth hacks. He really knew product design. So a lot of what you saw in Uber that he doesn't get credit for, I had long arguments with him about tipping as but one example. And, he was adamant to not have tipping in there, not because he didn't believe in tipping, but because he wanted efficiency. And that was a cognitive step. Okay, rate the driver was a major innovation, kept people in the system, got rid of people who maybe were bad actors in the system on both sides. But tipping just created a cognitive load that he didn't want to have in the app. Now they've since added it, but they added it after you give your rating, so you can kind of just ignore it. And many people do. In fact, the majority of people do, which is indicative of Travis being right. I think it's like 80 or 90% of people do not tip in these systems. So putting that aside, that's the builder founder. And multiple co-founders is another criteria for us. We like when there's 2, 3 co-founders. Why? If you want to go far, you go together. If you want to go fast, you go alone. And a lot of the folks who go alone and you see, they're solo founders. If you look back in the history of the company, there were 2 or 3 other co-founders who helped them get to the point at which that founder had enough power to fire everybody, like Zuckerberg. He had 2 founders or 3 co-founders, Eduardo and everybody else. And so, usually over time, 1 or 2 founders drop out. Snapchat and YouTube, I think, both had 3 founders, but we only know the names of 2 of them. And in fact, now with Snap, you probably only know Evan Spiegel. So multiple co-founders. Previously raised venture capital, previously had an exit. 2 more criteria. World-class design, a 5th criteria. A product outlier. And that was the one that I would say is weird. Like we don't understand the product, so product outlier. And then a founder who's an outlier. And so Travis is certainly a founder who's an outlier, charismatic, hard driving, super pumped, to use a term, it's his term. And so you really do, we have those 2 criteria, which are not, they're qualitative. So you can't really quantify them and say, there's 3 co-founders, or there's 3 co-founders, 2 of them are builders out of the 3, and they're this type of builder. So we look at those as indicators of getting more interested in the company. And then a business model in our core 5 is another criteria. We have 5 business models currently that we are pursuing. Marketplaces we love: consumer subscription, SaaS, business software subscriptions, fintech, and AI. And the 5th one, AI, is obviously a horizontal, vertical, and everything. The other 4 really speak to high gross margin businesses, and we really love high gross margin businesses. And in our list of reasons to not invest, low gross margin businesses or capital intensive businesses might be another way to say it. So that decision-making criteria is great because we want to have these very highly engaged debates about the companies we invest in. And we share that information with the founders. Hey, here's the things we really like about the startup. Here are the things we have concerns about. These are the things that came up in our deal memo. These are the things that came up in our diligence. Can we talk to you about them? Hey, you're a solo founder. Do you ever think about having a co-founder? How do you think about it? And they say, I've got 4 people who I consider co-founders. How much equity are they doing? 4%, 3%, 2%, and 1%. And we say, okay, together, maybe that does equal 2 co-founders, or maybe 1 additional co-founder, but that's a significant amount of equity. Those people will probably stick around, and hey, maybe this person's so charismatic and driven, and it's their 3rd startup. they can pull that off. Sounds good to me. And so decision making is critical because we're also now tracking in our database, and we track everything in a database. It's super important, and
What's your database?
it's a
Oh,
proprietary system.
proprietary
Yeah,
database. Okay.
yeah. So we do everything in a proprietary fashion, and I am,
You created your own database. You didn't use
yeah,
like something off the
no,
shelf.
no,
Okay.
we're definitely not using any of the systems out there. I consider this like a massive competitive advantage to build my own
Mm.
systems, and we have our own community systems and all different processes because remember, we're one of the high scale companies. We are not putting stuff in a Google sheet or some CRM off the shelf, which is what you should do if you're a 5-person firm. Remember, we're a 21-person firm, 20,000 applications, 50, 60, 70 meetings some weeks. I'm trying to get it to 100 meetings a week. I'm hiring researchers, by the way. If you want to work for us, you can start out as a researcher for 60K, go to an
Wow.
analyst for 70K, and then become an associate for 80K. And we're not the highest paying. You can get associate jobs that are double that at a major firm, but we're like a seed stage fund. That's what we can afford to pay. We hire a ton of researchers. 2 out of 3 researchers make it to the analyst position. 1 out of 3 analysts makes it to the associate position. And then from there, we'll find out over time. But we expect, for every 3 researchers we hire out of school and we train up in our model, we will have 1 make it to associate. And it's almost exactly that. One of them we wind up not continuing with, and then one of them winds up leaving. And then one of them winds up delighting us. And we are really, really rigorous about hiring those people and training those people. And I'm okay with one leaving because they don't want to work 60 hours a week and do 4 meetings a day. Doing 4 meetings a day, I don't know when the last time you put in a 20, I doubt you've done this or I've done this in a long time, but doing 20 meetings in a week, 4 a day, and writing coverage of it and preparing for each one, that's going to melt your brain for 9 out of 10 people. And that's my goal. I want to break people who can't do 20 meetings a week. And when people get to 500 meetings under their belt, and we record these meetings, these are introductory meetings, they're 20, 30 minutes. We have those meetings. We have the feedback. We have the founders rate our meetings. We ask them, hey, how'd your meeting go? As part of the process. When people get to 500 meetings, then they can go from researcher to analyst. They do another 500 meetings. They've got 1,000 founder meetings on the belt. They can become an associate. So most firms do not work like this. We're very unique in our approach. I think somebody can tell me I'm wrong. But again, remember, one of my core beliefs is the number of meetings in your deal flow is destiny. I want to meet with a lot of people. I would like to, at some point, have complete coverage. I would like to have met with 100% of venture-backed startups, in the seed stage. Very hard thing to do. I think probably Y Combinator at 45,000 applications. I think Gary Tan, shout out to Gary. I was a huge fan of Postgres, his first startup. I think he's awesome. I think they might have pretty close to complete information because of the 45,000 applications they get, I can tell you half of them are not venture investments, let's just say. Like, they could be pizzerias, they could be video games, things that venture capitalists aren't going to invest in because there's, music, whatever. But the other half, like probably the world of startups might be 20,000 starting a year. And then of those, maybe 5,000 get some level of funding or go to an incubator, maybe 4,000.
So what percentage do you think, what percentage do you think you're at today?
I think I know we're halfway to Y Combinator's applicants, and we're 1/5 of their number of investments. And we're not trying to beat or compete with Y Combinator, to be totally honest. We'd be happy to invest in Y Combinator companies. We're happy for our companies to go to Y Combinator, and that's happened. We've had companies from Y Combinator come to our accelerator, et cetera. When we think they're awesome. I mean, in fact, a lot of the lessons I learned was, just watching Paul Graham, and he is very, very focused. If you look at their application on builder founders, multiple co-founders. So those 2 things are observations I think he gets a lot of credit for in the industry. I don't think you can go to Y Combinator without a developer founder, without multiple co-founders. I just don't think you'll get in. And if somebody got in there as a solo founder, let me know. I don't think they will ever accept a solo founder. I think they're very rigid about that. And I don't think they'll accept a team with 2 or 3 idea or business or marketing people on it. I think they'll only accept a team with 2 or 3 technical people on it. That's their belief system, right? And I think he's right. Now, you do have some weird things that can happen, like Airbnb. So one of their biggest successes is 3 unbelievably thoughtful, leaders from RISD, Rhode Island School of Design, right?
Mm-hmm.
And so you do have to have some flexibility. So we are extremely focused on our process. Our process is very different. Most people do not want to do what we do. Most LPs don't understand what we do. I'd say about half of the LPs out there don't believe in what we do. And those
Really?
LPs are they're wrong, and they have the right to be wrong.
Well,
But
it's funny. There's a book called Top Grading um, uh, that goes into recruiting and talking about how do you. There are two types of recruiters. There are folks that look at a candidate and they look at it as an artist does, and says, "Oh, I just love the emotion. I love the flavor. I like the look." And then there's the airline pilot who's got the checklist, right? Which one do you think outperforms over time?
I've read the book, The Checklist Manifesto, and I can tell you it's the checklist.
The checklist absolutely matters.
Yeah.
Yeah. So that's an interesting. I mean, I think that might be
I'm a
key
fan
trait
of
that...
systems over goals. And the guy who writes Dilbert, Scott Adams, he's talked about this a lot. Systems over goals. A lot of people want to be thin, is the example he gives. They want to eat less sugar, but they keep sugar in their house. And they want to be in shape, but they don't go to the gym. And so, he has a very profound observation, which is he wanted to be in shape, so he just goes to the gym. And then sometimes if he's not feeling like it, he'll go to the gym, drink his coffee, I think, and then just leave. And he won't work out. But as a system, his system is go to the gym and then figure it out from there. His system is to not have sugar or flour in his house or whatever it is. Because, you're going to be a function of your environment. And there's other versions of this. He doesn't get full credit for it, but I think he explains it best out of everybody. He might be the origin of it. But I always look at process, and I think process determines outcomes. And that is something in sports they talk about a lot. You can't control the outcome. You could have a bad ref. So that's where I first heard it. And then I think Scott Adams says it quite elegantly. He's a little bit of a controversial figure. He went like full MAGA and a little bit loony, but a very interesting cat. I think he has some great moments of brilliance. Putting aside that, what is your process? If you tell me your process and your incentives, I will tell you the outcome, right? And people say that, show me the incentive, I'll show you the outcome. I think show me the process and I'll show you the outcome as well.
Now, do you incent your teams on the number of meetings, and like, do they get a dollar amount? Do they get like or they get a backslash?
We have a bonus and they have carry.
Okay.
But for young people, I don't think, because they're not fully developed, that they're not thinking long term.
Yeah.
Like your brain kind of gets that long term thinking sometime around 25 years old. And it's probably right when we're hiring them. And I know as a young person into my 30s, I wasn't really thinking about my retirement or anything. So I think the right person we hire should be based on their energy, and I hire them based on their ability to have high energy when talking to founders and high curiosity. I don't need them to be the best decision makers, I'll be totally frank. If they can get me the 20 companies a week with high energy, and then just tell me, how many of the tiles, the qualities we call the tiles, because they look like tiles in our database. We color code them. And so just have 2, 3, 4, 5 tiles. If it's got 2, 3, 4, 5 tiles, bring it to another person more senior than you. Do a second meeting. You don't have to overthink it. So I really want people who are high energy.
How many of the first meetings, how many convert into a second meeting?
Probably like a third, maybe. Yeah. I have to check that exact number. We do track that number.
And so 20,000 goes into 100 deals a year. Is that right?
Yeah.
So it's
50 basis points, 1 in 200.
So 50 basis points.
Yeah.
So it's not, while it's spray and pray, it's not really spray and pray.
No, it's spray and pray. Spray and pray rhymes, and anything that rhymes, if the glove doesn't fit, you must acquit. Spray and pray. If it rhymes, you remember it. If it rhymes, it's prime. I don't know. There's something just about things rhyming that make people think it's correct. The truth is, and this gets to our next point. So you have doubling down. And I think in terms of this conversation, doubling down is the one I am most focused on today. So in our fourth fund, we've deployed $12 million as of this week of what will be a $50 to $75 million fund. We're just closing it up. If you actually want to read the deal memo, go to launch.co/memo. And we'll be closing the fund May 1st. The reason I can talk about it is we elected to do 506C, whole other conversation. We are publicly raising. We had $110 million in interest from accredited investors. Can only take 10 million of that.
What was the URL again?
Launch.co/memo. And it's about a year old, but it's my memo for Launch Fund 4. And so I've been thinking about portfolio construction a whole bunch. And I looked at that first fund, 109 names, 4 unicorns, Superhuman, Robinhood, Calm, Density. And we went back, and Mike Savino, my partner, general partner and president, did a little analysis of it. And in looking at it with some of our LPs, they said if we had made one more investment, instead of that being like a 4.9x, 5x on paper, it would have been a 15x on paper if we had done a follow-on with one of those 4. And that makes sense, right? If you followed on to the Robinhood Calm deal or Superhuman deals, you would have a great investment. So why didn't we? Well, back in that day, you were trying to use your 100 swings at bat, or in the case of this $10 million fund, 109. We were trying to use those 100 swings at bat to hit one outlier based on the power law. And that's where the term spray and pray comes from. You spray, and then you pray, you hit the power law. We hit it 4 times. 1 in 26 is absurd, or 27 is absurd, to be sure. Let's be clear about that. And when I was a Sequoia Scout, I think I did 18 investments and 3 became unicorns. Thumbtack, DataStax, and of course Uber. So I hit 3 out of 18, so 1 in 6. So now if you look at my track record, it's plummeting. The number of unicorns, the ratio of unicorns to non-unicorns went from, I think, 1 in 6 to then 1 in 27. And I don't know where it sits now, but we'll see with those, more recent funds. You really only need to hit 1 in 100. Let's be honest, right? Because these pay off 200, right, 300, 400, or in the case of Uber, 2,000 or 5,000 to 1. So putting that aside, the question we asked ourselves, did we know that those were the outliers in the fund? And it was clear in 3 out of the 4. And so then I said to myself, can I make a heuristic? Can I make a system, right? Because systems over goals, process over performance, or process over outcomes. So what's the system or process? And I came up with, at the seed stage, what I think is a really good process for evaluating if we should make that second bet. And in this fund, let's say it's a $50 million fund, we'll put $25 million into primary investments in 250 companies, 100K in each, maybe 200 companies, 100 change in each. Okay, so 200 names. Now we have 25 million left over to put into the top of those names. So if we just picked a number, 10%, that would be 20 companies. That would be about $1 million into each, right? And so $1 million at the Series A round, 50 million, you get another 2%. Or if it's, the seed, or, a $30 million round, you get another 3%, another 5%, could be even another 7%, something in that range. Call it 2 to 7% for that million. So what we've decided to do is look at those 200 and then use half of the fund. That's my current thinking. Could change, but I'm currently thinking half the fund will be deployed into the top 5% to 10%. So that's either 10 names or 20 names, probably more likely 20 names, could be 30 even, could be 15%. But if we give that 20 million to 30 names, 750 on average, 500K on average, whatever it is, I think we got a pretty good shot of having 10% ownership, perhaps even 15% ownership in another unicorn. And, that's the thing I'm trying to do as a goal. We had that kind of ownership in a unicorn that came out of our accelerator, and we were able to clear some of our position in it, which was delightful for our LPs. And so that has actually happened. In our first 75 companies, we had a company, Grin, which became a unicorn, and we were able to sell a little bit in secondary. I can say that. We took advantage of that opportunity. People wanted to buy our shares, and we had over 10% ownership in that. So it is possible in this model to hit 10% ownership in a unicorn. We've done it already, and I believe we can do it again. And if you were to do that, 10% ownership in a unicorn comes with $1 billion, $2 billion, let alone a decacorn, you're going to have, and that's really what I'm playing for right now, is I believe if you look at what the average seed fund does, 3 or 4x on paper, or 3 or 4x DPI, maybe they hit 4 or 5 TVPI, they on paper. If you just return 3x consistently, that's a pretty darn good track record, isn't it? So you have to ask yourself, if the average at seed is like 3x, why doesn't everybody do seed? What I just explained to you is a ton of work. And the reason people don't do it is because they just want to make 30 bets. They don't want to make 200 bets in a fund. 30 bets with 5 partners is enough, or 4 partners or 3 partners, whatever you choose to have.
Agree. So do you have a set of heuristics? You said do you have a different set of heuristics for those double down bets? And that's in the Series A, right? Not in the seed.
It could be seed, Series A. Like if they went to our accelerator and we gave them the standard Y Combinator Techstars deal, we have 7% for 125K. So, if it was a seed round at 10 million and we put in 500K or 250K, we could add 2.5 to 5% to that position and hit the 10% goal. And so we look at 2 concepts, likely winners and definitive winners. And that's the basic heuristic. And I can get into what's in there at the seed stage, but it's profoundly different than the heuristics that you were giving me. But I like your heuristics, but I think those heuristics are for Series B and C, right?
Correct. That's for Series B and C. So we'd be thrilled to give you 5 to 20 million for each of those companies that match our heuristics.
Yeah.
For those B and C rounds, and it'd be quite lucrative.
Yeah, I mean, it's the SPVs are a great way to pass the hat and to keep the train going if you can figure those out. Yeah. And so right now, coming out of the seed round, we will typically see, if you look at those 4 companies, Robinhood, Calm, Density, Superhuman, in all cases, all 4 cases, there was a lead investor who wanted to own 10% of the company in the Series A and join the board. Those rounds are priced. There's a share price. They're not convertible notes. Somebody joins the board. It's a notable VC. And they want to own over 10%. If you think about the other rounds we see, and these rounds could result in a great outcome as well, but coming out of the pre-seed and seed stage and the incubator stage, you will see a lot of convertible notes. And you will see a party round, passing the hat, and then nobody's joining the board. There's no governance. And so that is the tier of likely winner. Definitive winners, we know for us it's a definitive winner because somebody's joining the board, it's a price round, and it's a notable partner at a notable firm kind of situation. And we're going to want to back up the truck in those situations. Those are our first priority. And then after that, anybody who's able to complete a round, if you're able to complete a round and it's a convertible note, it's a safe, it's a party round, there's 2 co-leads, who set the price? Nobody knows who set the price. The founder came up with what they thought the market clearing price was, and they just sent everybody an email and said, we're closing on this date. I have you down for 250. Are you in? How does 15 million sound? These other 2 people are cool with 15 million, and hopefully nobody checks, what the valuation was. And more power to founders. Those rounds take a lot of effort to get done, and that's why they are likely winners. And then the people who can't clear market and want us to fund them, as opposed to the market setting a price and funding them after they come out of the accelerator or the programs. We have 2 programs, Founder University and Launch Accelerator. Then we got to work with those folks. And try to help them get funding or figure out why they can't clear market. And if they can't clear market, their idea or their execution or their team or the market or competition or timing, it could be so many different issues, and usually it's a combination of those issues. And that's okay. We'll just tell those founders, hey, we tried an experiment, shut the company down. You're in our founder Slack. Let's talk about your next idea. You didn't clear market. It's okay. But we make it clear to them that we are not leading their next round, but we might co-lead or participate in it if they find a great lead. So let us know. which is kind of, I think, where Y Combinator is going to wind up. Remember, they had the continuity fund, I think they called it. It created a lot of drama because I think, like we're discussing here, how do you explain this to 500 founders every year, compounding? 5 years later, you got 2,500 startups.
Right. Why do you
I
leave
mean,
this one and not that one? You liked it's like choosing a favorite child.
right. And then if Y Combinator does it, if the continuity fund doesn't do it, oh Lord, and if they said they've got $1 billion, like they can't spare $1 million for you, I think it's like a
Yeah.
signaling issue. It's probably why Gary Tan acts it. And I think they're raising a couple of $1 billion now. And I think the way they do it now is everybody automatically gets $375,000 into whatever the price is of their next round. So they just basically get a convertible note that converts at whatever the market clearing price is. So I think that's a smart way for them to do it. And they get their 7% for 125 and then the 375. If the average clearing price is 10 million, they get another 3-4%. So they get them to 10%. So they're pursuing a very similar strategy to us, which seems like spray and pray, but is concentrating on the winners, I guess. But yeah, that's the big problem, is the signaling issue for at scale seed stage investors. We've been very clear about it. We only have enough dry powder for the top 5% of the portfolio. And we don't lead. So to be clear, we're not going to lead it.
Interesting. That's great. Well, that's a great synopsis, Jason.
Yeah.
Yeah, that's really remarkable. I learned a whole lot here in terms about systematic investing.
Yeah.
As a
Process.
superpower process.
People don't know I'm doing all this. I'm glad that you asked these really thoughtful questions about it.
Absolutely.
I think it's like everybody's like, oh, he has a podcast or two. Oh, he does. He gets lucky on an angel investment once in a while. I prefer people think that. I honestly, I prefer that. And I explain this stuff to LPs, and a lot of LPs don't understand it. And then some LPs are like, ah, I get it. But most people don't think at scale investing works. They think it will get you beta. And then I say to them, what's the beta of seed? And they say 3x. I'm like, what's the beta of venture? And they're like, 2x. I'm like, if we can deliver beta, we're 50% better than the Series A firms. And they're like, huh. But I don't think people have really thought this through and done the analysis of what I discovered. And people are probably asking, well, why would you explain it here? I'm literally not in competition with anybody. Like, Y Combinator accepts 1%, we accept 50 basis points. I think they're probably less than 1% now that I think about it. And they have more applications than us. So therefore, they've got more to choose from. So if we're accepting 50 basis points and doing 100 a year and they're doing 500 a year, that's 600. And if we think there's 10,000 quality startups made a year, between the two of us, we're doing 6%, which is to say 94% of startups don't go to launch or Y Combinator. Or if you add in the next 2 or 3 accelerators, and let's say it's 1,000 accelerator slots of note per year, which I think probably is what it is, 500 for them, 100 for us. Maybe there's 200 or 300 going to Techstars, maybe 100 or 200 going to 500 Global. Let's put it at 1,000. Let's put it at 1,500 people go through an accelerator every year. If 1,500 go through an accelerator out of the 10,000 legit startups, that means 85% don't go to an accelerator. Now, the interesting statistic would be how many of the unicorns went to an accelerator. And I think some people are starting to study that. And remember, Y Combinator's only existed for, less than 20 years. This is a new concept in venture, and it's just starting to emerge how powerful Y Combinator and Techstars, which started at the same time, and 500, which blew up for various reasons. It's just that data set is just starting to emerge. And I think as people look at it, even looking at 500 startups or Techstars, like, I think the returns are going to turn out to be pretty great and above average. And so once again, if you deliver beta, which my understanding is a fancy word for the average, with a chance of alpha in the seed stage, I think it's the best bet you can make. And I think it's the worst business you can run.
Why is that? Just hard work. It's hard work.
Yeah, I can tell you, most people who want to be in venture capital want to do it because it's easy. They want to do 5 meetings a week. one meeting a day. They want to take 6 weeks off in the summer, 6 weeks off in the winter. I mean, let's keep it a buck, Steve. We know these VCs. They do not work hard. They're not hardworking. It's the cushiest job ever. You make $1 million or $2 million or $3 million in fees a year. You get lazy. You have a couple of associates, and you live off the fees, and you get lucky, and you hit the power law, and it all works out. You want to have to sort through. Who wants to do 70 meetings a week and have debates and pick 2 of those companies to invest in a week on average and go through your programs? And running these programs, by the way, is capital intensive. No, they're $50 million firms do not have 21 employees. And everybody's like, how do you do that? I pay $1 million a year myself to pay for the staff. So I'm coming out of pocket for $1 million a year for the staff that doesn't get covered in management fees. So you can just do the math. Like, I have a very profitable podcast, This Week in Startups, and the events throw off a little bit of capital. So I'm able to underwrite a team size that is 3x what a $50 million. How many team members would a $50 million fund have typically, Steve, in your experience?
3 or 4 maybe.
Yeah. So let's say 5.
That would be a lot.
Yeah. Let's say 5.
Yeah.
Round it up to 5. I have 4 times that. So
yeah,
I'm not living off the fees here. I made my money from Uber already and Robinhood. I did okay. I want to be as helpful as I can to founders, and I want to build a great team and a great legacy. And, most funds, I just read the statistic from Carta or PitchBook. They said like only 15% of funds created in this last cycle are going to make it to a second fund. Like, that's pretty extraordinary. And they said it used to be half. So it's plummeted from 50% making it to the second fund to only 15%. So that's
very few. You make it to a third fund. Do you consider this? You're on fund 4 here. Do you consider this a fund 4? Do you consider this sort of your first, like, institutional effort or close to institutional effort?
I guess if you look at fund 3 and 4, that's when I had institutions, and fund 1 and 2 were all individuals. So yeah, it was a $10 million fund, then an $11 million fund. So this probably is arguably my second institutional fund, but then I also had the benefit of being a Sequoia Scout for a couple of years. So I kind of got to try this on for size for the first 8 years part-time. And it's only really the last 5 or 6 years when I've had these 2 funds that I've been really dedicated in building a process and a firm. So yeah, maybe I consider this my third fund. Combine the scouts and the first 2 would be 20 million or $21 million, almost exactly. So you put those 3 together, that would be my first fund. And then launch fund 3 would be 44 million, and this one will be 50 to 75. And, I'm not going for big funds, and I'm not trying to have 5 partners. I had that opportunity. I'm not trying to do late stage. I had that opportunity, and I had the opportunity twice to merge my operation with other large players who wanted to have a leader like me run a large operation that needed a leader. I'll leave it at that. And a large fund that didn't have seed exposure wanted to plug us in. Very notable firm as well. And I was like, let's see what I can build on my own. Let's see if I could build launch into my legacy. And I'm 53.
Mm-hmm.
I love what I do. I can imagine doing other things, but yeah, none of those other things are as enjoyable as doing a podcast with a founder and talking about tech and startups and finance every week, and then meeting with founders all day. Pretty great life.
Your launch and your podcast and your present, all of that reinforces your venture activity, right? It's not like
it's a flywheel.
You don't really think about, right? You don't really think about it as like, oh, I have to do this other job. It's just an extension of what you're doing.
Correct. Most people are like, oh, you spend all your time podcasting. I'm like, I don't go to lunch with anybody anymore because it was making me fat. I gained like 40 pounds because I could afford, for the first time in my life to order food at a fancy restaurant. I went a little crazy for 10 years there and gained like 40 pounds. And now I'm just like, instead of having this like 2-hour lunch and talking for 2 or 3 hours with somebody really smart, I just have them come on the pod. And This Week in Startups, I do 3 days a week, and I do all in 1 day a week. And it's 4 days a week.
That's awesome.
Yeah. And
wow.
It is like a great joy of my life.
Well, thank you for making us the Sith Day. So
I love
hopefully,
talking, and one of the great things in life is to have relationships over different uh, eras and different, arcs of your career. And you and I got to meet in the 90s when we were in our 20s and trying to figure out this internet thing. And then we got to see the boom and the bust. And then we got to see Web 2.0, great financial recession, then this crazy ZERP 15-year run, and then another bust. And now we
been a
start
hell
all
of a
over again
run.
with this AI revolution and all these like cycles and eras. I don't get all Taylor Swift here, but you get all these eras, you get to enjoy them and look back on them. I look back fondly on the Silicon Valley era that you and I were part of, the Web 2.0 era, was joyful. This last one, the Uber, Airbnb on demand, ZERP era was amazing. And I'm just thrilled with this next one. And what a
It'll
great
be
privilege
fun.
it is. Yeah. And
It
if
really,
anybody wants to apply for funding, Founder.University is our pre-accelerator, 12-week course. We wind up investing in about 10% of the people who come to that course. Launch Accelerator, and you can apply launch.co/apply, launch.co/apply. Apply for funding. My email for life will be jason@calacanis.com, my first name at my last name. And I'm Jason on Twitter/X, and I'm Jason on Instagram, and my DMs are open. And unfortunately, you can't add me on LinkedIn. I'm at the 30,000 cap. I think you can only follow me on that. But
you
myself or
have
my team monitors all that stuff, and yeah,
you have a team who monitors your emails.
I haven't given up the email box yet. But for the social media stuff, we have to like
Yeah,
have somebody look at my inbounds there because it gets a little crazy. But I try to do it myself. I like to make myself available. I watched as like certain folks. I remember Mark Andreessen. I would send him companies, and he didn't meet with them, and I was kind of bummed, because he was like a hero of mine. And
yeah.
I was like, Mark, I'm sending you companies, and like you don't meet with them. And he's like, well, I got people now, and like I watch people get weird and like become more reclusive, um, and then people like admonish people for emailing them or emailing them at the wrong stage, or they should know I don't invest in medical devices. I'm like, I get email can be um, oppressive looking at an email box, but you know what's more oppressive for a VC? An empty email box. So if you have to pick too many emails, too many people trying to get your time, or being a nobody and nobody cares, I'd say go with the former rather than the latter, and shut the heck up, shut the front door, as my daughters would say, shut the front door and take the meeting or read the email. It's not the
Yeah.
end of the world, folks.
For the institutional investors who are like, $70 million fund, why should I pay attention to this? That's like,
Yeah,
you
don't.
know, no,
I
no, no,
don't.
no,
Yeah.
no. I meant, do
Oh,
you have any aspirations for the future in terms of like, you
um,
know,
the next fund will be 100 maybe, and I'm really interested in what's going on in the Middle East. So I've been spending a lot of time in Abu Dhabi, Dubai, Riyadh, Doha. I've gone 3 times in a year, and I keep getting invited back, and I keep meeting partners over there and seeing the businesses they're building over there and their interest in venture here. So I'm really fascinated with their aggressive push into venture capital and their optimism. And to be totally honest, like the endowments here have gotten very large, and they can
mhm,
only write checks that are the size of my fund. Like if you go to an
yep,
endowment that's 10, 20, 30, $40 billion, their minimum check size is 50 million, and my fund is 50 million, and they don't want to be more than 10% of a fund. So, we're not worth their time. It's just they're not designed for this, and that's okay. And I have those people come to my liquidity event. I have them on the pod, and yeah, they look at our companies afterwards. Some of them are smart, um, and they will put a small bet into our fund, and then I give them a spreadsheet, and then I have somebody on my team email them when we have a company we think is promising, because some of them like to co-invest, and so some savvy larger entities, which I won't name, will put in a $1 to $5 million check into our fund so that we have a relationship and we're forced to get together every year and have lunch. Or, I send them emails and say, like a point guard, where do you like the ball? Right. So I like to bring the ball up the court. And some people want to dunk it when it's Series A. They just want me to give an alley oop. More than happy to do that with Sequoia, with Social Capital in Chamath, more than willing to do it with David Sachs. And those folks get the advantage. Valor, Antonio Gracias, those partners of ours, we will pass the ball right where they want it, and they get the advantage of us talking them up to our partners sincerely, because we respect them and we're partners with them, and getting in early. And they see value in that. Great. And then we get to learn from them. So, Antonio at Valor was nice enough to analyze all of my performance with his team. And then, a lot of the stuff I talked about today, Antonio taught me, because, he's like my big brother, or my brother who's more successful and has been doing this for twice as long as me. And, Valor was able to show me some weak points in my game and then show me the strengths of my game. And one of the strengths I brought up today, which was, at one point, Antonio was like, the beta of the seed stage is incredible. And I was like, it is? Like, yeah. Like, you realize most VC firms don't get to 3x. They get to 2x. You're hitting 3x consistently.
Well, half of all VC firms don't return anything.
Okay. So here we go. Right. So when you look at, how variable that is, if you can consistently do a seed stage fund that hits 2-3x, don't be afraid of the word average, because the word average in the seed stage means 3 times your money in 10 years or 12 years, or whatever it winds up being. Pretty darn good. So you can kind of own average at the early stage. And we're obviously going for alpha. We obviously want to get those 5 and 10 and 20x funds. That's my personal goal. But if we deliver average, so we deliver beta with the chance of alpha, I think we're going to be the best game in town. And for those other large funds, I think what's going to wind up happening is we're going to top out at 100 million in terms of fund size, because I don't want it to get unruly. And even Y Combinator, the mighty Y Combinator, if they're doing 400 companies at 500 each, that's 200 million, right? So, it's kind of hard to put a lot of money to work in this category, right? So if you did, because they're doing 125, that initial bet of 125K, if you do that, 100 times, it's really not that much money.
Right.
It's $12 million. And if you do it, I don't know if they did 400, maybe they do 400 now, it's $50 million. So it's really not a lot of money to do 400, 125K bets. Now, if you want to put continuation bets in, if we were to catch up to Y Combinator, which is possible, that's one way to go about it. Or the other way is to just do a little more follow on. It's like, I think we'll top out at 100 million. And then I'll be honest, as I'm looking at this and the flywheel keeps growing, the existing LPs I have are going to re-up, or 80% of them re-up.
Right.
And then I'm going to want to put my own money in, because I'm starting to look at my family office. And when I put money into other funds, I'm now going, you know what? I could put 250K into this other fund, or 100K. Usually I start with putting in 25 or 50K. Then I go to 100 to 250K. And sometimes I'll do 250 to 500K in a fund that's not mine. And I'm like, maybe I just put that into my fund. I don't believe my strategy more than I'm believing the strategy I'm hearing from other folks. And so I am more inclined to put my own money into my own fund. And I could see a moment in time where I do what Hunter Walk did at Homebrew. Did you see that? That they decided
he did it himself.
Yeah, Homebrew I think it was after, somebody got to look it up. After the second or third fund, they told their LPs, "Great working with you. We're going to work with our own capital." So you ever watch that TV show Billions? And then there's
Absolutely.
like one moment in time, Axe Cap is like, I'm going to bet my own money. I'm going to do my own book.
If you're making those types of returns, why should you give that opportunity to others?
There is an answer. It makes you sharper. So I've bought into poker tournaments myself, but then with my friends, we like to buy a piece of the action. So let's say you're going to buy into the World Series of Poker for $10,000. In my friend group, I'll always be like, "Oh, can I take $1,000 of your 10,000, and then just send me the best hands that you're in, so I can get the action in it." But it also, when people have done that with me and staked me in a game like that, and I put in 5,000 and five of my friends put in 1,000, I play better. I play more thoughtful because I'm like, I really care. So I'm not going to do stupid things. I'm going to be more thoughtful. I'm going to be more crisp, right? Because with my own money, I could be loosey goosey.
It does make you disciplined. It makes you walk away from bad hands. It makes you more. It's one thing to lose your own money. It's another thing to lose other people's money. And
so I think I think I'll be 50-50 at some point. So maybe in the next couple of years, I'll be, some amount of my money, some amount of other people's money, 50-50.
Listen, I know that it's been a challenging
day
for you today.
An hour, yeah.
You mentioned AI. That seems to be like the if you have one more question about that.
Yeah.
Like, it seems to be the new software.
Mm-hmm.
It seems to be like the new, but it seems pretty real. How do you conceptualize it? How do you think about it? It's everyone has their own perspective, but is this, you mentioned it as one of your 5 segments. Doesn't it pervasively enter all of those segments?
You're exactly right. So I would say 100% of startups are using AI internally to run their companies faster, better, cheaper, more efficiently. And then I'd say 3 out of 4 of the startups we're investing in right now are, I don't know if I'd say half are AI first, which is they're leading with AI. We're making a co-pilot for accountants. We're making screenplay writing software with AI first. So we're going to replace Final Draft or whatever with, Saga, this new AI-based screenplay writing and storyboarding software. So yeah, I do think it's, first. AI first half the time, and then I'd say 3 out of 4 then are AI either first or primarily, and or significantly, and then there's probably like a quarter of them that necessarily, AI isn't like in the first 5 slides of the pitch deck. It's just infecting how they are thinking and building their company. So it's kind of like saying cloud computing. Like, is Uber a cloud company? No, it's a mobile company. It's a network-based company. But are they racking their own servers? No, of course they're using the cloud. So I think it's like we're probably halfway to the point at which saying AI would be like saying software, to your point. Maybe even 2/3 of the way there, that it would be kind of like silly to be like there were mobile startups for a while. And you'd be like, oh yeah, Hotel Tonight is a mobile travel startup. And then now you're like, well, yeah, SPG and Bonvoy have a mobile app and it's great. And you can book a hotel in it. And United's, got a great app. So you don't need Hotel Tonight necessarily to, everybody's got a mobile app. It's like the idea that that Walmart or, HEB supermarket in Texas wouldn't have a mobile app is crazy. Now, is it as good as Instacart? Probably not, but good enough.
So we've had 30 years, you and I, of experience in the tech sector. Is this time different, or does it remind you of any other years in the past, or like how would you characterize today's investment climate?
Yeah,
and
I think this will be the best vintage in our lifetimes, simply because the infrastructure to build companies has gone down precipitously, and then the number of people online with their credit cards in their smart device attached to their bodies with broadband accessible at all times is kind of reached 100% of the modern world. Like the idea that a human being on planet Earth will not have a smart device on them with their payment system in it. I mean, who's left? You and I lived through the digital divide in America, and we watched as it was like only 3 million people have broadband and 30 million people are on AOL. So 33 million of 300 million Americans, 10% of the country are online. There's a great digital divide, and poor people can't afford the internet. And now people are like, poor people can't afford the internet. It's like, are you sure? Because in India, you can buy an Android phone for $15, and the service is either free or a couple of dollars a month. Like Android phones, $15.
And he's in the washroom giving you hand towels. Yeah. It's really remarkable.
Yeah. I mean, like you could I didn't have cash. I was at the valet, and I was apologizing profusely for the second time with the same valet at the hotel I was staying at for not giving him a tip. And I'm like, oh my God, I am so sorry. And he goes, I have Venmo. And I was like, you do? He's like almost all my tips come from Venmo. I'm like, why don't you put a sign that says tip on Venmo? It's like, they won't let us. It's the Ritz-Carlton. I'm like, oh, can I pay you? And he's like, literally just took his phone out, put the thing, boop, and I tipped him in Venmo. Now, did you know valets are taking Venmo? Did you know that? Have you tipped a valet in Venmo?
I have, but
okay.
It's and actually I'm looking at a hotel company that and software that enables hotels to tip employees, which is pretty interesting market.
I'd like to meet that company. I actually looked at, there was I don't want to say the name of it because we were talking to this one company in Europe that I was at a rope course with my daughters, and they had a screen that said tip the staff, and you just tip this one QR code, and then it showed you the staff's pictures, and you could pick who you wanted to give the tip to. And it was just like a SaaS product. And I was like, oh, that's brilliant.
Well, we should chat more.
I definitely want to know about that one. Yeah.
We should definitely connect more often. And
let's do some deals.
Let's do some deals. It's been too long. It's time. We're all grown up. We know where we're going.
Yep.
And super great to see you, Jason. Thank you for
coming. So great for having me. Thanks. Great to catch up. I'll see you when I'm in New York. Go Knicks.
Go Knicks. We'll talk to you soon, Jason.
Cheers, brother.
Thanks a lot.
Thanks for listening to the Driving Alpha podcast, where we host top investors to demonstrate how they outperform the market. Click subscribe so you don't miss future episodes.